Inflation doesn't announce itself. It doesn't send a letter. It doesn't show up as a line item on any statement. And it doesn't reduce the number on your account balance by a single dollar. That's precisely what makes it the most dangerous risk facing Australian retirees in 2026. Not because it's severe, but because it's invisible, and because different types of retirement assets are being eroded by it at completely different rates, in ways most retirees have never had explained to them clearly. Today, I'm walking through exactly how inflation affects 6 distinct categories of retirement assets: cash, fixed income, account-based pensions, the age pension itself, property, and shares, because understanding the different erosion rates across these categories is the only way to actually protect your retirement income from a risk that never shows up as a visible loss. Inflation in Australia in 2026 sits within the Reserve Bank's target band of 2% to 3% annually, which sounds modest when described as a single number, but compounds into something far more consequential over a 20 to 30-year retirement. At 2.5% average annual inflation, prices double approximately every 28 years. At 3.5%, they double every 20 years. For a retiree who plans their finances around today's costs and today's dollar values, that means the purchasing power of every dollar they hold is being silently halved somewhere between year 20 and year 28 of their retirement. And the asset classes I'm covering today are eroded by that process at meaningfully different speeds, which is exactly why a one-size-fits-all retirement portfolio almost always gets this wrong. Cash is the asset class most retirees instinctively believe is the safest, and it is the one inflation erodes the most aggressively, in the most mathematically certain way. Of anything covered in this video, a retiree holding $100,000 in a high-interest savings account, earning 4.5% in 2026, at an inflation rate of 3%, is earning a real return of only 1.5% before tax, and after tax, at even a modest marginal rate, the real after-tax return frequently falls to zero or negative. The mechanism is unambiguous and mathematically certain, unlike market risk, which is uncertain but potentially avoidable through diversification. Inflation against cash holdings is a guaranteed, ongoing erosion, with no possibility of avoiding it as long as the money remains in cash. Modeled over a 20-year retirement, $200,000 held entirely in cash, earning a real after-tax return of 0.5% above inflation, barely maintains its purchasing power, while the same $200,000 held in a diversified growth portfolio, earning a real return of 4% to 5% above inflation, roughly doubles in real purchasing power over the same period. The practical implication is not that retirees should hold zero cash. A cash buffer, as covered extensively in our previous videos on sequence of returns risk, remains essential for managing short-term volatility. The implication is that any cash holding beyond the 2 to 3 year buffer, genuinely required for living expenses, is actively losing real value every single year it sits there, and should be recognized as a deliberate trade-off for stability, not mistaken for a safe, long-term store of wealth. Fixed income, term deposits, fixed-rate bonds, and similar products carries a specific inflation risk that's frequently misunderstood because these products feel safer than they actually are. Over an inflation-adjusted time horizon, a 3-year term deposit locked in at 4.2% in 2026 guarantees that exact nominal return, regardless of what happens to inflation over those 3 years. If inflation runs at 3% as expected, the real return is a modest but positive 1.2%. If inflation unexpectedly rises to 5% during that locked period, which has happened in Australia within the past several years, the real return on that same term deposit becomes negative 0.8%. And crucially, the retiree cannot exit the product early without penalty to respond to that change. This is the specific trap fixed income carries that cash in a flexible savings account doesn't. The lock-in period removes the retiree's ability to respond to inflation surprises during the term. For a retiree holding $150,000 across multiple laddered term deposits, an unexpected inflation spike to 5% for 2 years represents an effective real terms loss of approximately $2,700 per year. In purchasing power, that cannot be corrected until the terms mature and funds can be redirected. The practical approach is to ladder fixed income holdings across multiple maturity dates, rather than locking a large sum into a single long-term product, preserving some ability to respond to changing inflation conditions without sacrificing the income certainty fixed income is meant to provide. This is where the news becomes genuinely good, but only under specific conditions that not every retiree's superstructure satisfies. An account-based pension holding a growth-oriented investment mix inside pension phase has two structural advantages against inflation that cash and fixed income simply don't have. First, the zero-tax treatment of investment earnings in pension phase means 100% of any nominal return contributes to real purchasing power, rather than being partially eroded by tax before it even has a chance to outpace inflation. Second, growth assets, shares and property held within the superstructure have historically generated returns that meaningfully exceed inflation over long periods, unlike cash and fixed income, which are designed primarily to match or slightly exceed it. The critical qualifier is structure, an account-based pension that has been shifted entirely into conservative, cash-heavy, or fixed-income-heavy allocations, as covered in our video on why retirees run out of money in year 12, loses this inflation protection almost entirely because it's simply holding the same poorly performing against inflation asset classes. Inside a more tax-efficient wrapper, a $600,000 account-based pension held in a balanced growth allocation, generating an average 7% nominal return against 3% inflation, produces a real return of approximately 4% annually, completely tax-free, while the identical $600,000 shifted to a conservative cash and bond-heavy allocation at the same retirement might generate only 5% nominal against the same 3% inflation, a real return of just 5%. The structure of the pension phase wrapper provides the tax efficiency. The actual asset allocation inside it determines whether that efficiency translates into genuine inflation protection. The age pension is explicitly designed to be inflation protected, indexed twice yearly in March and September, based on movements in the Consumer Price Index and the Pensioner and Beneficiary Living Cost Index, with the higher of the two measures applied. This is a genuine structural advantage the age pension has over almost every other retirement income source. It's one of the only income streams in an Australian retiree's portfolio, explicitly built to track cost of living changes rather than requiring active management to keep pace. The qualifier that most pension recipients don't fully appreciate is that the indexation tracks general cost of living measures, which don't necessarily match an individual retiree's specific spending pattern. And as covered in our Medicare video, healthcare costs for Australians over 65 have consistently risen faster than general CPI, at rates closer to 5% to 6% annually. Compared to the broader inflation rate the pension is indexed against. This means a pension recipient whose personal spending skews heavily toward healthcare, aged care services, or other categories rising faster than general CPI, experiences a gradual, real terms erosion in their effective living standard, even while their nominal pension payment is being correctly and faithfully indexed to the official measure. The age pension is genuinely one of the better protected income sources against inflation in the Australian system. But better protected doesn't mean fully protected against every individual retiree's actual cost structure. Residential property has historically performed well as a long-term inflation hedge in Australia. Property values and rental income have generally tracked or exceeded inflation over multi-decade periods, partly because construction costs, land scarcity in capital cities, and population growth all tend to rise alongside or ahead of general inflation. The specific risk that catches retirees holding investment property, however, isn't the long-term capital value. It's short to medium-term cash flow during periods when inflation rises. Faster than rental income can be adjusted. A retiree relying on rental income to fund living expenses, where that rental income is fixed under a 12-month lease, while general living costs are rising at 5% to 6% during an inflationary period, experiences a genuine cash flow squeeze for the duration of that lease term, even though the property's underlying value is likely keeping pace or ahead of inflation over the longer term. Additionally, the costs of owning an investment property, council rates, insurance, maintenance, and any mortgage interest on a variable rate loan frequently rise faster than rental income can be adjusted within existing lease terms, creating a genuine, if usually temporary, mismatch between rising costs and lagging income during inflationary periods. The practical implication for retirees relying on investment property income is to build a cash buffer specifically sized to manage this rental lag risk, separate from the buffer held against share market sequence of returns risk, recognizing that property's strong long-term inflation protection doesn't eliminate short-term cash flow vulnerability. Australian shares have historically provided the strongest inflation protection of any major asset class over multi-decade periods because company revenues and profits generally rise alongside inflation over time. Companies raise prices, wages, and asset values broadly track the same inflationary pressures, affecting the wider economy. The ASX 200 long-term average return has consistently exceeded average inflation by a meaningful margin over rolling 20-year periods, even accounting for the significant short-term volatility shares experience. This is precisely why shares form the core growth component of a well-structured account-based pension. As covered in Asset Class 3, the specific risk shares carry isn't poor long-term inflation protection. It's that the short-term volatility can be severe and poorly timed, which is exactly the sequence of returns risk covered extensively in our retirement depletion video. A retiree fully exposed to shares with no cash buffer, forced to sell during a market downturn that happens to coincide with high inflation, a combination that has occurred in Australian economic history, experiences the worst of both risks simultaneously. The solution, consistent with every other asset class covered today, isn't avoiding shares because of their short-term volatility, but structuring a portfolio where the long-term inflation protection shares genuinely provide isn't undermined by being forced to access that protection at exactly the wrong moment. Bringing all 6 asset classes together, the practical framework for protecting a retirement portfolio against inflation has 3 integrated layers. The first layer is a cash buffer covering 2 to 3 years of essential expenses, accepting that this layer will lose real purchasing power over time as a deliberate trade-off for the stability it provides against sequence of returns risk, not mistaking it for genuine long-term inflation protection. The second layer is a moderate allocation to laddered fixed income, structured across multiple maturity dates rather than locked into a single long-term product, providing income certainty while preserving some ability to respond to inflation surprises. The third and largest layer, for the portion of the portfolio not required for the next 2 to 3 years, is growth-oriented assets, Australian and international shares, and property where appropriate, held inside the tax-advantaged pension phase structure, specifically to maximize the inflation-beating potential that zero-tax growth assets provide. The age pension, where applicable, functions as a fourth, largely automatic layer of inflation protection through its biannual indexation, requiring no active management, but benefiting from explicit coordination with the super drawdown strategy covered in our 4% rule video. 4 specific actions. First, calculate exactly how much of your current retirement assets sit in cash beyond your essential 2 to 3 year buffer, and honestly assess whether that excess cash is a deliberate stability decision, or simply inertia, because every dollar beyond the genuine buffer requirement is losing real purchasing power with mathematical certainty. Second, if you hold fixed income or term deposits, check whether they're laddered across multiple maturity dates or concentrated in a single long-term lock-in, and consider restructuring toward a ladder if you currently hold a large single maturity position. Third, review your account-based pension's actual asset allocation, not just confirming you're in pension phase for the tax benefit, but confirming the underlying investment mix is growth-oriented enough to genuinely outpace inflation over your remaining time horizon, rather than having drifted into an overly conservative allocation. Fourth, if you rely on investment property rental income, build a specific cash reserve to manage the rental lag risk during inflationary periods, separate from your share market sequence of returns buffer. Inflation is genuinely the quietest risk in retirement planning, precisely because it never produces a single moment of visible loss to react to. No market crash headline, no compliance letter, no obvious trigger. It simply, silently, and mathematically reduces what every dollar of every asset class can buy, at different rates depending on where that dollar is held. The retirees who protect themselves against this risk aren't the ones who avoid it through some clever single trick. There isn't one. They are the ones who understand that cash, fixed income, pension phase growth assets, the age pension, property, and shares all respond to inflation completely differently, and who build a portfolio that deliberately accounts for those differences, rather than treating every dollar as if it behaves the same way. If this gave you a clearer picture of where your own retirement assets sit, subscribe and hit the notification bell. More straight-talking Australian finance content every week. Thanks for watching. I'll see you in the next one.